You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. Well, welcome everybody. That was a good intro. I remember doing that back about 25 years ago. Welcome to a smarter way home for home financing, mortgage strategies for real estate professionals and home buyers alike. I am your host, Victor Bals, and my other co-host,
Danielle Boote.
And how are we doing today, Danielle?
I'm doing great, Vic. How are you today?
All right, and I think we got a pretty packed show here today, and you brought up a topic. What are we talking about today?
We are talking about the psychology of home buying, 2021 style.
The 2021 style, the psychology of a home buyer. And that is, I don't want to say weird, but there happens to be a lot of psychology in there. You know, and you and I had a discussion the other day, and one of the topics we talked about is how can a home buyer spend days, weeks, months looking for a home, but yet they won't spend an hour with the lender discussing mortgage strategies and all the options they have. Well, what do you think about that? Well,
it's honestly a huge issue, and I think you and I discussed the other day that we're seeing this in greater numbers, even in the past month or two. What occurs in our world is, guess what? Buyers are out looking at homes with realtors. They have never talked to a lender. They don't necessarily know where their credit scores are or if they qualify or what program. And realtors are showing them homes without a pre-approval. And you and I get involved with a call at Sunday night at 8 o'clock with somebody's hair on fire because they need a pre-approval now and the listing agent's calling for highest and best.
Yeah, and we just happen to be the lenders that they know is going to answer their phone on Friday night at 8:30 to get it done, which we do, but I almost feel sorry for some of our home buyers because, yeah, we can get them a mortgage, but is it the best mortgage for them? And now they start to do this in the 11th hour.
Right. Now, you know, from a typical pre-approval standpoint, obviously we need to discuss
a pre-qualification.
Pre-qualification.
Let's discuss what's the difference between a pre-qualification and a pre-approval, Danielle?
According to the Cfpb, or the Consumer Financial Protection Bureau, they're essentially the same thing. Okay, a buyer is going to call a lender, give them some personal information. The credit will likely be checked, but they're going to give us information regarding income and assets.
So this is all verbal information at this point.
Correct.
Okay.
Correct. When we review that information, according to the CFPB standards, as a lender, we have to give the client whatever they want.
Okay.
So if they want to just give us verbal information, we can give them some kind of a pre-qualification that states they're potentially eligible for a mortgage subject to verification of all their documents.
Okay. And you know, you and I together been doing this about 50 years combined experience here, and yet I find so many home buyers that just want to put an offer in on a house, and they typically by default just maybe go online or listen to their father. We call it the FBI, the fathers, brothers, and the in-laws, or the metaphor that we utilize is Barstool Billy, the guy they use for advice, and saying, just go online, get a mortgage, and get the lowest rate possible. And it seems like many buyers are programmed this way, and by default they do that, not knowing what they're going to get into, and they depend on the real estate agent to take them to the promised land. I'm approved for a mortgage, take me to the promised land.
Right, and the difficulty with today's market is that there are more buyers than there are homes for sale. Typically, we're seeing multiple offers on properties, correct?
Yeah, absolutely.
And if the buyer doesn't understand the terms of their financing, how their down payment works, how the closing costs work, what the payment is going to look like to them, how can they write a strategic offer? And if they're calling it, Sunday at 8 o'clock, we've got to go through a lot of information to get them
Yeah.
where they need to be even be competitive in this market. And we do have a lot of strategies that will help a buyer be competitive. But again, if they're only focused on interest rate, they're completely missing the boat.
Okay, so and as we talk about the psychology of a buyer or someone getting a mortgage, I have this conversation all the time, and I ask a buyer, I go, are you objective conscious? Are you payment conscious? Are you rate conscious? Or are you cash to close conscious? And I say, and I'll answer a call, and the first call I get will say, what's your lowest rate on a 30-year rate mortgage? And I say, well, what rate would you want? And that really throws them off, throws them off tilt. And I go, well, you can get any rate you want. And they go, well, I want the lowest rate in the world because that's what I was programmed to do. And I'll say, okay, how would you like a 2% rate? And they said, yeah, I would love it. And I'll tell that consumer, I go, well, on that particular program, it's only amortized only not 30 years, but 3 years, and your payment's $9,000 a month. And they say, well, wait a minute, I can't afford that. And I say, I thought you were rate conscious. They said, well, no, I can't afford that payment. I go, oh, so you're payment conscious? And they say, well, I guess so. And then I'll say, well, how about if I give you an 8% rate? And they say, no way. And I say, wait a minute. Let's give you an 8% rate and let's amortize that mortgage over 150 years and your payment's $300 a month. Would you entertain that idea? They say, well, yeah, you mean I can own a home. I never really pay down the principal, but I can gain the appreciation over 30 years. And I said, yeah. They said, sign me up. And I said, well, we can't because that program isn't actually available. I'm just trying to see, are you rate conscious or payment conscious? And now you're telling me you're payment conscious. And they said, yeah. And I go, well, if you want a payment conscious and you want to buy that $350,000 home and you want that payment, well, you only need to bring $210,000 to the closing table. And they say, I don't have that kind of money. And I said, oh, I thought you were payment conscious and rate conscious. They say, no, I'm cash to close conscious. And they say, what's the hell is that objective conscious? I go, well, you made an objective. I want a roof over my head. So if you don't make that conscious decision that I want a new home, rates, payment, and cash to close don't mean anything, do they? And they say, no. And I said, well, why don't you come on in and let's discuss your consciousness and let's educate you on this stuff. And I have that conversation with clients all the time. And, that's that barrier you got to get through when we have these conversations. And a lot of times it's on a Friday night at 8:30. Yep. How do we get through to the consumers to do that, to get those face-to-face meetings with us?
Exactly. And in a similar situation, I have a lot of buyers that call and say, well, we're first-time home buyers. We're not going to spend over X amount for a house, and we want our payment to be in this range.
Yep.
Sometimes they're realistic and sometimes they're not. But many times once they start looking with a realtor and realize the age or the condition of the home that they're going to get for that assumed budget, they go, wait a minute, we don't want to live in a house that's 100 years old, that's going to need ongoing maintenance, or a house that's going to need to be completely gutted in order to have it be in the condition we want. And then that'll sometimes open up the door where we can have the discussion and say, did you know that if you spent $25,000 more, you're going to get a better house in better condition with potentially more upgrades, because there's a cost of home ownership. It's not just that low payment.
And that $25,000 more is only going to affect their payment by roughly about $125. And this goes into the psychology of a home buyer, because many times I say, well, how much can you afford? What do you want your payment to be? And they come up with a payment, right?
Right.
And I ask, well, how did you determine that payment? And they say, well, that's based off the debt we have with the car payments, the lease, the student loans, the snowmobile, and all that. I go, that's pretty interesting. So you're going to settle for a home payment based off your current debt. And a lot of these potential customers, they've owned a home and they have a lot of equity, and they want to sell their home, pull all that equity, and put all that equity down on a new home, not knowing that maybe we should take that equity and pay off some of this debts here. Don't bring that with us, which could now afford them a much more of a home so they're not settling. What is the thought process on that? How do you go about talking to a customer about that?
Well, depending on the client's situation, I mean, it's important to look at what they have available to spend, whether it's savings or equity in their current home. Absolutely look at their overall debt situation and go, okay, can we improve this? Because if you're selling a house, absolutely the psychology is to put as much money as you can down, but there's nothing wrong with leaving a little for savings, maybe refreshing an emergency fund if they don't have it, paying down debt, or a combination, of multiple factors, having money to move into the house, to put new flooring in, to repaint,
emergencies,
to buy a couch or a lawnmower, so that they're not resorting to same as cash financing after closing.
Danielle, I get this question all the time. Look, I'm going to sell my house. I'm going to take those proceeds and I'm going to put 20% down on the next house to avoid PMI because PMI is the devil. What would you say to a client that's thinking in those terms?
Well, PMI, I think you have to look at it as an opportunity cost, okay? There is cost of investing money, and there's an opportunity cost lost by potentially pulling that money out of the market or another investment. And what I try to tell people is, look, maybe 10 or 15% down would make more sense, leave you with some reserves. If putting 20% down puts you in a position where you're going to be cash strapped or worrying about buying carpeting for the house, same as cash after closing, that's a problem. I mean,
so you're concerned about, I don't care about getting you a mortgage. I'm more concerned about where are we going to be post-closing so we don't leave your house broke.
Exactly. The goal here with any client is to make sure that A, they're not house poor, B, they understand how the financing works, balancing their budget, really making sure that they understand it. One of the biggest things that I see is occasionally we get rescue deals, okay? We get a client that went to another lender and things go sideways. They're not closing on time. And when they come to us for a second opinion, I kind of start right at the beginning. I assume they know nothing and go through the typical questions that we do. And sure enough, probably 9 times out of 10, we find out that they don't understand the loan program. They don't understand the down payment, the closing cost, or the payment scenario.
Or the options.
They were just told that they're approved for X amount.
Right. Here, but let's stop there. Explain the difference. Are you approved for a mortgage amount or a payment amount? People ask that question all the time. Vic, can I afford this house? And I ask them, well, what are the taxes? Explain that.
Well, you actually are approved for a payment. And part of that house payment is going to be homeowners insurance, property taxes, and possibly PMI. Now, property taxes vary based on the location of the home. What county is it in? What city or township is it in? Okay. There can be a huge difference.
Well, how I explain that to clients, and because I say, I'm going to ask you 2 questions. When you call me up and say, hey, Vic, can I close on this house? Can I get it done? I'm going to ask you 2 questions. What is the purchase price and what is the taxes?
Correct.
And the taxes are so important, and I give them an example. If the taxes were $12,000 a year, that would equate to $1,000 a month affecting your payment, versus if they're $3,000 a year, it's $250 a month in a payment. And now they start to get it. So now clients call me and they give me the price and the taxes so we can calculate, because those taxes not only affect your payment, they affect your cash to close. So when they give me a price and the taxes, we can calculate cash to close and payment correctly.
Correct. And we estimate up front. Yep. So we will ask the question, where do you think you want to live? Being in the Metro Detroit area, we have 6 or 8 counties that clients can buy in, and they're all extremely different. So there's a difference between Oakland County, Wayne County, Livingston County, Washtenaw County. Sometimes we'll find cheaper houses in an area that has higher taxes, and then all of a sudden they're not happy with the payment because they had no idea that the taxes literally going, a mile or so over a county line could double the tax rate.
So our tips to our real estate professionals and our consumer, regardless of whatever lender you're working with, is make sure the lender has the price and the taxes so we can give our consumers a cash to close within a couple $100 and a payment within about $10 to say, are we going to go after that home?
Correct. And honestly, when you're a buyer or a seller, you don't do this all day long.
Right.
It's our job to educate our clients to make sure that they're prepared and ready, and that when they have a question, they get the proper answer. It puts them in a better position to negotiate. How do you sell a house without being pre-approved and knowing where you're going to go and what it's going to cost you. Because what if, everybody can think, well, my house is going to sell for $350,000. Well, maybe you sell it for more. Maybe you sell it for less, right? We have to start somewhere with a conservative estimate and say, here's where we're going to be, and here's what your options are. For instance, if somebody sells a house, I'm going to give them their best case scenario and worst case scenario. So for instance, if it's conventional, their worst case scenario might be a minimum of 5% down as a second-time home buyer, potentially. But certainly, could they put more? Absolutely. So you look at those, and I like to give people a range so that they're prepared, so that they're not negotiating on the sale of their home blind.
Absolutely. But this is also about educating them on where they're going to be with those proceeds. Maybe they could buy first without selling, right? Which will give them a higher probability there. But you brought up something about first-time home buyers. And people have owned a home before. What's the definition of a first-time home buyer? Let's set our consumer and our real estate professionals straight here.
Great question. Anyone who has not owned a home in the last 3 years is considered a first-time home buyer. So maybe somebody owned a home 5-10 years ago and been renting for various reasons. They are considered a first-time home buyer, maybe eligible for some special financing options.
So if I owned a home 3.5 years ago, so now I'm eligible as a first-time home buyer, which would make me eligible for that 3% down conventional loan.
Correct.
That's excellent. Okay, when I'm on the phone there with clients there, I get a lot of this stuff because I'm always just curious with home buyers and understand what they don't realize they know. They'll call an online lender, I got a pre-approval, take me to the promised land, right? And I start talking to them and I start just asking them questions. And I said, well, did you know that you could put less than 20% down? Sure, you'll have PMI, but did you realize you can buy out of that PMI for up to about a 40% discount upfront at closing? And they'll say, Vic, I never knew that. And then we start looking at credit scores, and I say, by improving your credit scores just a bit, we can drop your interest rate or get you into a better program and maybe go from a conventional or a government program to conventional. They said, well, I didn't know that. That, if you buy first and then you sell, you have a higher probability of getting an accepted offer. And then these buyers say, I didn't know that. That 2 borrowers on the loan can actually reduce your PMI rather than just having 1 borrower on that loan.
And that's a super important distinction that really just changed in the last 18 months, maybe, that the PMI companies have changed how they price loans. And even with PMI, no one, I think, understands how important your credit score is. When it comes to credit scores, PMI and interest rates are based on what your scores are, and it's in 20-point buckets.
Yep.
So there's a difference between 680 and 700.
And 700 to 720.
Correct. And that goes, frankly, all the way up to, I think, the top tier of the bucket is 740 to 760.
740, you become, you get the best interest rates and the lowest cost. Once you're above 760, you get the best and the lowest cost on PMI insurance. There,
right. So when you really, like I had a customer the other day, and they're buying in the 350 range. When they thought the PMI would be a couple $100 a month, and they had top tier credit, and the PMI was, I think, 60 or 70 bucks a month. And they went, you're kidding, Danielle. I said, no, look, we can still keep you on budget. You can maintain savings. You're not tapping into 401ks or retirement long-term funds, because there's a cost of taking those funds out of the market. Yeah. And it doesn't matter how much you put down on your house. Your house is only going to appreciate on an annual basis based on what the house is worth. Your mortgage has nothing to do with your property appreciation.
I think buying out of the PMI is probably one of the coolest functional tools you have. Yeah. And one of the things that people didn't know here that, maybe we don't put 20% down, as maybe we pay off some of our existing debt. We can actually structure loans of putting 5% down, buying out of the PMI, paying off any existing debts they have and have their new home that's $150,000 more expensive, have the total cash outflow less than their current situation with their current payment and their current debt load. And I tell you, people are enlightened like that, and they just go, I've never seen the light. I've never known that.
Right.
And that's why it is so important to have a face-to-face, because you can't see this stuff on the phone. You got to see it on the big screen.
Right. One of the things that I discuss, particularly with first-time home buyers and payment ranges, is what are they currently paying for rent? Mm-hmm. The issue that we're seeing with anybody renting is that the rents right now are going dramatically up. You know, in our community, just for an apartment, you're probably looking between $1,100 and $1,500 a month. Single family home rentals will be much higher than that. And we can keep people in that range now, in many, many cases, even with low down. So you got to look at it realistically and go, you know, with buying a home, you're going to protect your budget in the future, right? Your income should continue to go up for most people, even at a moderate 3%. You know, taxes and insurance may adjust after you purchase a home, but the principal and interest won't.
And this goes to the psychology of a home buyer.
Mm-hmm.
You know what? The market's too crazy. I'm just going to stay in rent right now.
Yeah.
Or prices are up too high. I don't want to pay that. And when we talk about exactly what you're talking about there is we talk about paying today's debts with tomorrow's dollars. And people have a hard time understanding that concept. But if we say, for example, that client's house payment is going to be $1,000 a month, and they say, ooh, that's a little tight. We say, but remember, that's a fixed debt. So let's pay today's debts, this new mortgage, with $1,000 principal and interest payment with tomorrow's dollars, and that goes to what you say, because that person making $60,000 a year who gets a 3% raise is going to make $1,800 more next year. Or that equates to $150 a month.
Right.
So that $1,000 payment this year is going to feel like $850 next year, which is going to feel like $700 the following year, because we're paying today's debts with tomorrow's dollars, versus I'm going to stay here and rent, and my rent is going to go up each year 3%, keeping up and eating up any potential raise. So,
right.
So renting never seems to get you ahead of the game.
No, I had a client that we just closed last week. They have been married for 11 years and have been renting for 11 years. And they struggled trying to figure out where they wanted to be and how much they wanted to spend. And I did tell them, I said, I think we equated that they had spent $90,000, or, I mean, it was a ridiculous sum of money over 10 years of renting.
And what were they thinking? What was their psychological thought process behind this?
They were worried about the payment. That's all they were worried about. And they wanted their house payment to be less than their rent. And I said, well, you've been renting for 10 or 11 years. Look at what you've spent over this time, and you have nothing to show for it.
No appreciation.
No, right, correct. No tax deductions, no appreciation. And now we're near the lowest interest rates in history.
But yet they still balked up to this point.
They did. I was shocked that I'm glad we got them closed. It took them a while to be able to.
But what was their background, their upbringing? What do you think brought them into that thought process of, I want to buy, but I'm scared of a payment?
Well, they were saving, and they had a good amount of savings, but I think they struggled early on, and when they were younger, so they must have struggled a bit.
But yet
they were
saved
afraid.
money, so
they did. Yeah.
Okay.
Yeah.
And and the thing is people think they need to save a lot of money to take advantage of home ownership.
Right. I think especially first-time home buyers, they're very confused because of social media and the internet. Okay. They get out there and they start reading, but they're not always reading something that is good advice or is 100% factual, and they don't trust it. And this is typical, of let's call the millennial generation, where they're not very trusting. I have actually found more first-time home buyers that do want to meet face-to-face, whether it's in person or like on a Zoom call or something of that nature, because they want to build that relationship, which I highly encourage, because they're hearing so much noise, and then some of them shut down because they don't know what to believe and what to trust. And then they go, well, I don't know what to do now because I don't understand any of this. And you go, well, I can help you. That's where we can help and we can educate. My job is not to make a decision for any buyer, right? My job is to educate them, give them the tools that they need to feel secure enough to make that educated decision.
Because of all the false claims or just not being coached right. And I talk to buyers there, and when they go online or just say they call up a lender because of their upbringing, the father syndrome, Barstool Billy, who's ever given them this information, just go get a mortgage and get the lowest rate and don't pay PMI, put 20% down, and all that. To me, that's like going to the pharmacy for weight loss and buying a generic diet pill because it's got the same ingredients, it's the lowest cost, and it's going to take me to the promised land and I'm going to lose weight. But yet, why is the weight loss industry $150 billion a year? Because most of it don't work.
Right.
And I try to explain to customers that, if you're going to go on a diet, a mortgage diet, a real estate diet, is maybe you need to see a personal trainer. Because your diet on a diet pill may be different than somebody else's. Your metabolic rate, we don't know. Your debt may be different. Your credit scores may be different. Your income may fluctuate. You may have a stay-at-home spouse. You may have student loans. You may be in college now working part-time, but your payments are going to graduate and make more income. That's a very specific diet pill that needs a trainer to give them to educate them on how we can keep them healthy for the next 30 years.
And how often do we hear from clients that say, well, my friend or my family member just got this rate? Yeah. And you go, well, let's see. What was their down payment? What was their credit score? All of those things that go into it. And you go, okay, well, do you know we can do a mortgage for somebody that has a 620 score, sometimes lower, but they're going to pay a higher rate than someone that has a 700 score. And frankly, we're not going to, nobody in their family life or with friends, nobody discusses credit scores, do they?
Well,
kind of like your weight, right? We're not going to talk about that on the podcast. You can talk. I'm not talking about that.
But when we talk about when they get it from the FBI, the fathers, brothers, or in-laws, or Barstool Billy, well, my buddy got the lowest rate in the world. People don't understand. Mortgages and real estate transactions are like hamburgers. They go through milestones. They go through pre-approval. They go through underwriting. They go through processing. They get clear to close. They go through the lock test. You go through home inspection, appraisal. These are all milestones in a mortgage, and they're just like a hamburger. But your hamburger may be completely different than Barstool Billy's because you may want extra pickles, no onions with a toasted bun, and we have to treat every hamburger as unique to that particular individual.
Right.
And Barstool Billy don't get it.
Yeah. Well, one of the issues, and you and I chatted about this the other day, and let's talk a little bit about a history lesson here. In the early 2000s, for those of us that were in real estate, one of the issues that we ran into as loan officers is we would get clients that would call and say, hey, what's your rate, Danielle? And I'd say, well, rates today are 5.5 on a 30-year fix. Well, what about an ARM? And then I would hear...
That's an adjustable rate mortgage.
Correct. And then I would hear from a client, even a past client that I had a relationship with, that would say, hey, somebody gave me a rate of 1.99%. And, those of us that had been around a long time in the industry knew that an adjustable rate mortgage with high closing fees, including discount points, or the interest-only issue, that was also around back then, that is no longer a thing.
Option arms. Any of you guys that remember.
You might get an interest rate of 1.99% back then, but maybe that rate was an intro teaser rate that was only there for 6 months. You were going to pay, through the roof for fees, and the consumer had no idea what they were signing up for.
Oh, but they got what they wanted. They wanted the lowest rate.
They wanted the lowest rate. Exactly.
And they got it. And back then, they tried to refinance in 2 years or sell the home and come to find out that they had a 3% prepayment penalty.
Absolutely.
Back in the day.
Right. So as consumers, I think we have to be really careful. Now, there are still adjustable rate mortgages, but honestly, nobody does them because the rates are not attractive. The interest only arms are gone. The option arms are gone. But especially first time home buyers, they've read about that stuff and it scares them. And, but as a consumer, if you don't understand what you're signing, it is buyer beware because everything's disclosed in writing. But when we give somebody a loan application package, there's about 50 pages of documents, and I will guarantee you that most people don't read them and they don't understand. And they didn't understand 15 years ago. That's when people got in trouble. So you have to be careful for the fine print. If the rate sounds too low and too good to be true, there's probably is.
Well, and I actually had one of those option arms back in the day, but I was a mortgage professional, so I understood them. And I just want our consumers and our real estate professionals alike to understand there is no such thing as a bad loan or a loan program out there. These are tools in a toolbox. And if the lender can educate the consumer on how to utilize these tools for that specific job, they can work absolutely wonderful. But if you're not educated, these things could burn you to the end.
Correct. Now, current mortgages do not have a prepayment penalty, for instance. So one of the questions that I get asked frequently from a client is, what about a mortgage less than 30 years? Well, you can do 15, 20, and 25-year loans as well. Obviously, you're going to have a higher payment with a shorter loan term, but did you know that you can take a secure 30-year fixed rate mortgage and you can always pay extra if you wanted to, but in the case of an emergency, let's talk about that for a moment because nobody wants to think about the future. Frankly, a mortgage in most cases is longer than most people's marriages. Okay, it's a 30-year contract. Life is going to happen, right? People might get sick. There could be a death in the family. There could be good things. There could be a marriage. There could be children that come along. Maybe somebody loses a job or has a short-term injury that takes somebody out of the workforce for a while.
Life catches up.
Life is going to catch up and happen. So if we can prepare someone to be the most successful homeowner, most people nowadays that I find take a 30-year mortgage. But they can always pay extra. But then if there's a problem in life, they can pull back that extra payment and pay the minimum 30-year payment. It might get them through tight times.
Is it fair to say this, that if an individual goes with a 30-year mortgage, they're going to pay a little bit higher interest rate than a 15 or a shorter term mortgage, but don't consider it a higher rate. Consider it an insurance policy to give you the option to make the minimum payment if these tight times come about.
Correct. Okay. Correct. And the difference between a 15 and a 30, depending on credit score, is usually nowadays what?
0.25%.
0.25%. Yeah. That's not a big deal when we're talking about interest rates in the low 3 to high 2% range.
But if your rate's 0.25% lower, but your payment's 35% higher, where's the quality of life and where's the account for emergencies in case something else life catches up?
Right. Now, one thing that I find pretty interesting, because I am a little bit of a history buff. So I have spent, 30 years in the mortgage industry, and I love learning about the history of finance in America. So did you know that back in the 1920s, when you wanted to own a home, you would go to your local bank or savings and loan, you would borrow money from that institution. And when you look back at the history, for instance, of an FHA mortgage and the Department of Housing and Urban Development, they came about after the Great Depression. So what occurred if you studied history at all and you heard about the Great Depression, what occurred back then when the banks collapsed is that because of the way these mortgages were written, the bank could call that note due and payable instantly for any reason.
Really? I didn't know that.
So what happened back then was when everybody ran to the banks to withdraw their money, okay, the banks had a run, literally it was called a run on the bank. The bank then went to everybody that it borrowed money to, the farmers, the homeowners, whoever it was, and they said, we need you to pay your loan back. You got 3 days.
Wow.
Or a week or whatever. It was a very short period of time. So one of the things that has occurred with the federal government stepping in and regulating banking, and again, this goes back to the 1930s, is that they said you cannot have a payable due clause like that. We don't have that in our mortgages today. If we give you a 30-year fixed rate mortgage, you have that mortgage for 30 years as long as you don't default. We can never call you and tell you got to pay the loan back. So when you look at the post-depression era, people were afraid of the banks because of what happened in the late 1920s, so almost 100 years ago, because people lost their homes even though they had paid all the payments on time because the banks called the note due and payable. Correct.
Wow.
So HUD standardized that. FHA protected consumers and had to rebuild the consumer confidence. So when you look at, and at our age, it's frankly our grandparents' generation, they didn't trust the banks. You heard about people having mattress money, cash in coffee cans buried in the backyard. It's because they were hiding it from the banks, and that's why people lost their homes.
Oh, okay. And as they have children and their children have children, all these episodes, memories, and experiences passed down as the father syndrome.
Right.
About paying cash, put as much down, avoid PMI because of... So that goes to the psychology of our home buyers.
And I have had very few people over the years call me and say, I'm unhappy with my 30-year mortgage. Now, if we do a 30-year mortgage and they're doing well and they can pay extra, fantastic. But I have had people do 15-year mortgages and call me and say, hey, Danielle, we got a problem.
We're going back to a 30.
My husband lost his job, and this happened in the last 15 years. We would have people that ended up retiring early. Right? They had planned on working 10 or 15 years, paying off the house, and now they're without an income. They're stuck in a 15-year mortgage.
And they can't qualify for a 30 because
they don't have a job. Right. And they retired early. So maybe, you have all these problems where if somebody, I have taken people from a 30-year mortgage, if rates, decreased, then we can put them in a 15 and the payment's the same. But the big thing that most consumers really fail on is having an emergency fund and savings. So why are you worried about paying $200, $300, $400 a month extra on a mortgage if you don't have the savings to back you up for life's emergencies?
Wow. So we've talked about a lot of stuff today. We want to wrap up the show here. So what would be your words of wisdom to our first, second, third home time buyers of what should they do? It
doesn't matter how many homes you've owned, whether it's your first or your third or fourth or whatever. You need to meet with a current, a mortgage professional to go over your situation, to come up with the best strategy and prepare before you start looking at homes or before you list your home.
Or how about this? Come and see us, meet face to face, let us educate you. Yeah. Then you can go shop all you want, but at least you're an educated consumer.
Exactly.
Is that good enough?
I think it is. I think it is. So but if you have fears or anxiety about buying a house, then get educated first.
Get educated first. Well, that's Danielle Boote, and I'm Victor Bals, and that about wraps up our show. And I guess our message is, hey, we got to all come together and make this world better and try. Thank you.
Yeah, we got